right now the dollar value is good. Loving Victoria at the moment. The naysayers will go, oh, what about land tax? But you remember, we're commercial investors. We factor in land tax to our calculations, so it hasn't affected us. And if it has, we've already factored it in the yield and getting it at a better price.
But it's a weird job, of course, being the German who tells the Australians how their country works.
The office isn't dead, it's just evolving.
This number gets smaller. We could call them instances of baby boomer women deaths, but that's morbid. So we just call it wealth transfer.
I could not see a task where replacing a person with AI in our service model business.
Well, does this mean death and destruction for commercial property, for our office towers? Should we board them up and let nature take over? And I would argue not.
G'day, how you going? Welcome to Inside Commercial Property. Phil Tarrant here, your co-host, joined by the ever-reliable Scott O'Neill, founder, Rethink Group. How you going? You well?
Good, mate. Good.
Anything to report after the weekend? Nothing?
No, not really. Just busy at work.
Yeah.
It's all happening this time of year. Got Easter holidays around the break, but yeah, it's full swing at the moment. I've never seen it busier.
That's good, right?
It is. It is.
Commercial busy or resi busy?
Both.
Yeah.
Like even last month, we did almost 130 mil in property transactions, so that's pretty good for us, and the momentum's building too. So we've got a larger team and got a greater reach in the market, and that's allowing us to find more deals. And even despite that, we're still falling behind the demand. So it's an industry-wide problem. There's no solution to keeping up with the demand unless you sort of sacrifice quality, which we won't do. But yeah, look, it's good times. Interest rates are dropping. The buyers are pretty active in all sectors, mostly industrial, followed retail's right up there at the moment. Office, it's a little bit quieter, but that's turning in certain segments. So yeah, we're seeing it's going to be a really good period ahead.
I've seen some posts on social media recently, some acquisitions that you've made, some pretty high asset value stuff. I've also seen you on the social media with, it looks like you lead a pretty quite interesting life with all your posts on and whatnot on it. So as a quick insight of the market, any state in particular you like at the moment?
Yeah, look, we love Southeast Queensland. We love parts of North Queensland as well. New South Wales, we're becoming more active because some yield decompression has seen the yields go higher than we've seen in the last 5 years. So we're seeing that as an opportunity to get in at a good yield, or a better price rather, and that should mean there's some good capital growth once the yield compression sinks back in. When that compression will start, probably another rate cut or two, we'll see. But right now the dollar value is good. Loving Victoria at the moment. The naysayers will go, oh, what about land tax? But you remember, we're commercial investors. We factor in land tax to our calculations, so it hasn't affected us. And if it has, we've already factored it in the yield and getting it at a better price. So the land tax is priced in, which is that's the opportunity. And even if they don't repeal the tax and it's there forever, we've already purchased it at the right price. So Victoria is regionals, and Victoria and Melbourne itself, really good market. Loving Tassie. Places like Perth and Adelaide, where there's just not much deal flow there at the right yield. Still a strong market, but you've got to get the price right, just because there might be some perceived lower capital growth over a 10-year period. Massive generalisation, but yeah, really good stable markets, low supply, seeing record tight vacancy rates for certain segments. So yeah, it's all looking pretty promising, to be honest, out there. So it's market wide.
Sounds okay. And while I've got you, no doubt we'll look at how some of the factors shaping demographic shifts today, but we're just a couple of days after the cyclone up in Queensland around Brizzy. Any consequence for commercial investors there?
Good question. I spoke with Trent Nolan, our insurance broker. He had a number of roof leak quotes or claims out there. So no flood affected properties. It's really just small wind damage and leaks and damage to sort of little parts of properties here. But yeah, we've bought thousands of properties in those markets over the years. So to hear that little to be affected, it's pretty good. So yeah, it's just a claim process for those who've been affected. And yeah, look, there's been no major damage, put it that way. So yeah, pretty thankful for that.
That's good to hear. And I know there's a lot of people doing it tough still up there in Queensland. So our thoughts are with you as you stuck into the cleanup, but it's not going to be the first or the last cyclone there. So as you're making your commercial investments, maybe it should be something you should be considering. Speak to a good broker beforehand, insurance broker, to see how it may impact it. But I would imagine you would say don't invest in flood zones, right?
Yeah, and look, flood zones. There's all sorts of different maps out there, so you got to pick the right flood map and find out if it was affected or not. Some flood maps are over conservative, and some may be the other way. So you got to be careful in that department.
Do due diligence. But that's not what we're here to talk about today. The main game. So we have a special guest, and Scott, you and your team have done a great job getting our guest in, Simon Kuestenmacher. Some of you may know or have heard of him. He's got 700,000 global followers on social media. So he's been around, and I really enjoy chatting to demographers. And it's one of the great privileges I get in my job is that I get to speak to people who are much smarter than me, looking at demographic trends, consumer insights, and cultural changes shaping Australia. Simon, welcome to the show. How are you going? You well?
Oh, very good. Yeah, thanks for having me.
So you concentrate on the Australian market, but it's a funny sounding accent you got there. Where's home for you originally, mate?
I'm from Germany. I've been here though for 18 plus years, so this is definitely home for now. But it's a weird job, of course, being the German who tells the Australians how their country works.
Yeah, I thought so. And how are we doing here at the moment, Australia? You've been here 18 years, so you're no doubt an Aussie. Are we doing okay?
You're doing very okay here, and there's no holding back for Australia. So all of the general negativity that we hear about the here and now, and we just mentioned it before, a bit of negative sentiment about Victoria, for example. These things, the more you zoom out, the less you care about them. The less you care about these small shifts, and you look about the major trends that very much tell a story of Australia being a stable country, a stable democracy, more importantly, who operates, fair enough, on a super simplistic business model. We're not a very complex economy at all, but the simple things that we do well, and they're not at risk, even if we consider this crazy geopolitical environment of uncertainty at the moment. We do mining, we do agriculture, we do tourism, we do international education. There's nothing else that Australia does that matters to the rest of the world whatsoever. That is all we do, and none of these things are structurally speaking at major risk. So that means we continue to be a very attractive destination for, let's say, migrants from around the world, but also for a bag of money that tries to find a new home anywhere in the globe, because we might not offer the next Facebook or OpenAI here, but we offer very stable growth. We offer stability, and that is what you want if you have an aging portfolio, where more and more of your clients, of course, want the stability as they age, and we have plenty of that. So hedge your bets globally, and sooner or later you'll throw a bit of money at Australia.
So you've probably got a whole bunch of insights that you can share with us, and we're going to try and put it through the lens of commercial property and how property investors can make more informed decisions on where and how to shape their investment portfolio in and around of commercial property. However, you're in the business of demographics. Bernard Salt, who a lot of our listeners would know from his time at KPMG, you guys co-founded the demographics group. Now, what does a demographer do for a living other than just give us whimsical insights on what's going on in the world?
Well, more than anything, we dig through heaps of data all day, every day, and then we try to make sense of it. And part of this is storytelling, is always looking at the data itself and then thinking, okay, what do those shifts, sometimes they're big, sometimes they're small, what do they mean for our clients? And our clients are, from a consulting perspective, there's of course lots of property related clients, there's lots of local governments who want to understand these shifts, but we work with dog foods, we work with the big blue chips around Australia. Anything, self-serving narrative, of course, anything has a demographic angle to their business model, and we are willing to just think through what this might be for your business. And today we'll be playing around commercial property.
Yeah, and I'm a pretty simple man, and the question I need to ask you, why do demographics matter when you're making property investment decisions, particularly around commercial property?
Well, in the most simplistic view, you sell property to people. So if you look at your house, it's very important to understand how many people we can expect in the future and how many people will be in what stage of the life cycle. So what type of property do they want? Then of course it matters what kind of jobs those people might be having, because that then is interesting in terms of, well, where are we placing our commercial districts and where would people want to live in order to commute? How do all of those working from home trends and broader social trends fit into, you know, the willingness or unwillingness of people to commute? And what does this then mean for you know, throwing your money at office towers, so to speak, if people are reluctant to go there? And how much do personal preferences actually matter, because broader shifts are pushing people back to the office towers in the long run?
So Scott, Simon's talking about the shifting fortunes of the office market, and a lot of people post-COVID thought office has done its dash, but it's certainly got a lot of legs left in it.
Yeah, for sure. Like, there's obviously some weakness around the CBDs, which is basically what all the media attention is, and all those big reports from the major real estate companies. But even the fringe office at the moment, we love it as an investment class because, number one, there's no supply out there hitting it, and also because of the changing demographics of the market, we're seeing more people move into the fringes. You know, that Melbourne case study of it, that endless urban sprawl, you need satellite offices more and more. So we're seeing, due to the lack of supply and obviously more people living around them post-COVID, the changing behaviour. I really like that office segment because it's not sitting on 100-storey towers and it's just more scarce. So yeah, there's definitely weaknesses and strengths in the office market.
So can you just crystallise for me what fringe office would be, or what would it look like? What would it feel like?
It's probably just like your suburban office. So, you know, think about people who might live in Western Sydney. There's small pockets where little satellite towns in amongst residential markets. There might be your 1 to 5 story buildings, so much smaller. They've got car parking. They're cheaper as well, and that's important as well, because think about the square metre rates in the city. They might be $1,000 a square metre. You can rent these places for $250 as an example. So it can be a quarter of the cost, closer to home. Yeah, you're not going to get big blue chip multinational companies in there, but there's a demand for it at the moment. So that's one asset class to look at.
And in terms of wider population shifts or movements in Australia, Scott mentioned very quickly southeast Queensland and likes of right now. We know it just got hit by the cyclone there, but it would appear that every man and his dog is moving up to southeast Queensland for better lifestyle and a better family upbringing. Does it really matter? You looking at these trends around shifts in population, because population means jobs, jobs means commercial property. How connected is your decision making when you sort of get this common thread of demographics or population shifts around it?
Oh, it's huge. Like, population's one of the big ones as well. Like, we've got 1 million extra people living in Australia compared to 12 months ago. So what's that going to mean? It's good for retail. It's good for even office spaces, industrial. Like, it's just the local demand increased, you know, by pretty decent percent, and it's increasing further. And as we know with Australia, a lot of the population centres in, you know, 5 major spots as well. So those areas will benefit the most from this population growth. And as an investor, I just feel confident in it. Like, we've got a higher baseline to deal with the commercial, you know, productivity and load out there. That's, you know, no doubt going to push prices higher. So, you know, inflation, and, you know, that'll go into the rents, and as the rents go up, then property prices will follow. So I feel confident, and the vacancy rates around the country are verifying things are pretty good off the back of that population.
In terms of those population shifts, Simons, what would be the sort of broad themes that you could sort of articulate or crystallise that the seismic changes in the way in which Australians are living or where they're living right now?
Well, you want to think about where population growth comes from in Australia. And we are overwhelmingly a migration nation, so about 2/3 of population growth, a bit closer to 70% at the moment, comes from overseas, meaning we import migrants and the rest is homegrown, more babies born than people dying. So that's important to understand. And you then need to have an opinion about immigration, not so much a personal opinion, but a informed opinion about, will this high population growth continue? How will this develop? And what will the politics about migration be in the future? And I'm of the opinion that it really doesn't matter at all which party is in power, because we will see high migration inflow of let's call it roughly 250,000 net new people year after year. And there has been a lot of noise about migration numbers in the last couple of years because, of course, the pandemic hits, we see a population outflow early on, which changes the equation. For the first time, people leave Australia rather than coming to Australia. That's because we tell them early on in the pandemic years that no financial assistance is going to be extended to them. They leave. Then they return in high numbers. We saw the really stark return of migrants just in the one and a half last years or so. And people think about this is madness. We have high house prices and we've taken so many migrants. The migrant Ponzi scheme is a phrase being thrown around a lot. But I always urge people to stay cool, calm and collected because there has been no real surge in migration intake. All that happened is that we took in 3.5 years worth of international students who make up close to half of our migration intake in just 1.5 years. So this means we shoot up the migration numbers like crazy temporarily. This already went down so that we will from now on see roughly 250,000 net new migrants. It was at 600,000 net new migrants for a short time. But that is now falling, guaranteed. And that's it. So if you plan ahead as an investor, I would say think about roughly 250,000 net new migrants. Add on top of this about 100,000 more babies being born than people die in Australia each year. And so you come to a number of around 350,000 net new people in Australia that need to be housed, that consume, that work somewhere. That of course drives all different types of property sectors, and you then want to have an idea of who's coming and where are they going to live. And the story here is pretty simple. Half of the migrants are international students. They go to the universities that are clustered in the inner cities of our big cities. So most of those people just flow into temporary, relatively small style accommodation, sometimes purpose-built student accommodation, smack bang at the center of town. That happens. The skilled migrants that we take in, they also want to flow to the center of town because most of the jobs are clustered in the center of town. So all the newbies arrive into the city center. Well, does that mean the city center completely overflows? Not at all. Because what's happening demographically speaking over the next 12 years or so is we continue what we've started with the beginning of the pandemic. We take the whole millennial generation, so people born in the 80s and 90s, who at the start of the pandemic didn't have babies. And now they are making babies. They're living at the moment in their hipster apartments in the inner suburbs. So your Fortitude Valley, your Fitzroy, your Surrey Hills, wherever it is. And they now add those 1.5 kids to their households. The apartment becomes cramped. They need a bigger dwelling. These bigger dwellings aren't available in the inner city, so we need to move out of the inner city. They can't move to the middle suburbs, which is what their baby boomer parents have done in the past, to find bigger dwellings because their beloved baby boomer parents are hogging the 3 and 4 bedroom stock as empty nesters in the middle suburbs. They're also great NIMBYs, so they blocked residential development in their neighborhoods for the last decades. So millennials have to move to the urban fringe. So we now take the biggest generation ever, the millennials, and we put them as far away from the CBD as we possibly can to the urban fringe of Australia. And well, and now we are a bit confused about why these millennials are so reluctant to return to the office. They are young parents, they want to be engaged with their kids, and they have the longest commute of any part of the workforce. So of course they fight tooth and nail, and we now think about different approaches how to deal with them. New South Wales decided to force the public servants back into the office. Victoria figured, we better don't do this. And they have a good argument in Victoria because Melbourne is an even bigger city, geographically speaking, even more spread out. And they lived through longer lockdowns, so you have more reluctancy to go to the office because you really settled down into the working from home rhythm a bit more in Victoria. So we pushed them out. And well, does this mean death and destruction for commercial property, for our office towers? Should we board them up and let nature take over? And I would argue not. I would argue that despite the negative chit-chat about office space at the moment. Ultimately, we will see much more vibrant, much more active CBDs than ever before in our Australian cities, but not in the short term. It'll take a couple of years, so to speak, but in the long run, everything points towards an absolutely resurgent of knowledge work in the office towers.
And do you think that's going to be complemented, though, by hubs outside of the CBDs in the regional centres or suburban centres for those millennials now who are structurally and probably permanently moved out to the fringes of the city? Are we going to see more hubs like your Penrith or Campbelltown starting to thrive in these environments?
Yes, and that has long been, of course, a specific urban planning goal to distribute jobs within a city better. You want to remember that just because of the freak nature of our geography in Australia, we are the country in the world where we concentrate the largest share of the population in just 5 cities. About 70% of our population lives in the big 5 cities. Around 80% of population growth occurs in the big 5 cities. So we are further concentrating our population. Why is that so? Because every state in Australia looks the same. They are very far apart, so they're not all that well linked to one another. So each state gets one big fat capital city, then maximum a handful of smaller satellite regional cities, and then, a couple of dozens of really small regional towns that essentially just exist so that you can get your tractor fixed locally. That's it. We are not distributing our population across evenly sized cities, and so that means we need to manage just a handful of gigantic cities. Traditionally, we pushed all of our office jobs into the CBD, and then we said, yeah, well, you commute in and out of the CBD at the same time, and that worked for quite a while. But you see this in Melbourne and Sydney occur at roughly the 4.5 million people mark, that this star-shaped commuting pattern, everyone in at the same time, everyone out at the same time, stopped working. It leads to gridlock. And we then talk about, okay, we really need to create secondary employment hubs, as they're called, in our cities. Sydney is now stretching into some sort of like sausage-shaped city where you have the Rocks, the traditional CBD. Then you go all the way out to Airport West. In the middle, you throw out Parramatta, Penrith, whatever you want to call it. So you have the idea that you stretch Sydney across 3 CBDs, whereas Melbourne gets one big CBD and a loop of smaller CBDs around it. The problem is that we tried this for 70 years. Plan Melbourne 1954 has the exact same secondary employment hubs marked on it as we are talking about right now. Why this isn't happening at scale, the decentralization, is that jobs benefit from clustering. Not the workers hate it, the workers need to do this annoying commute. The workers would be served much better if we had jobs more evenly distributed across several CBDs. But the jobs benefit, per se, the employers. It's helpful to have an office tower full of accountants next to an office tower full of bankers, next to an office tower full of consultants, and then a tower next to public servants. And this is a good ecosystem. But it's very difficult to keep this city functioning in this style, and we're now coping with the negative consequences of this.
And what would be the consequence of that? So these sort of migratory shifts, or let's call it sort of generational living shifts out into the burbs and the fringes, and within the paradigm of the heart and souls of the commercial engines of the capitals, or the cities are still going to be the capitals. What's going to be the consequence for the retail and industrial property sector, considering those sort of shifting dynamics? Because I'm listening to you and I'm thinking about Sydney in particular, it sounds like it's broken.
Yes, well, Sydney and Melbourne are both broken, if you will. So these are both cities that don't work as much anymore. We, historically speaking, started with cities that resembled European cities in style, where you have a dense CBD population, and then everyone travels in car, and not in cars, because this is 1930s, 40s that we're talking about. You travel by bicycle, by tram, you walk, and only once we gave cars to our people, we started to have this massive urban sprawl, which didn't happen in Europe. And with this urban sprawl occurring, all of a sudden we are allowed to massively lower our population density. So we create these car-dependent, gigantic cities. Population density in a European city is about 4 to 5 times higher on average than it is in a Australian city. So we carry, as Australian taxpayers, an infrastructure backpack that is around 4 to 5 times as high as the ones of European taxpayers. So if you are complaining about, oh, why can't we have decent infrastructure? Why is my public transport not as frequent as in Europe? It doesn't make sense in Australia this way. We're now trying to rectify this by densifying cities, but densifying cities is a slow-moving beast. So urban sprawl will be the way forward, to be honest, in the next decade. If you look at any urban plan in Australia, at the moment we talk about infill development goals. So we say, hey, how about we put 80% of our new population in infill development and only 20% on urban sprawl? It doesn't make sense financially, because developing a square meter of housing on the outskirts of town is about a third the cost of creating a square meter of housing in infill development of a medium density or high density tower. So if you grow cities at predictable, strong numbers, Sydney at 80,000 people a year, Melbourne at 100,000 people per year, and we have this insane housing shortage to begin with, what housing is going to be built? It is the fastest and the cheapest. And the fastest and the cheapest housing are the same housing type. Bulldoze land on the outfields, on the outskirts of town, and put a cheap box on top. That is how we're going to house most of our population, regardless of the, from an urban planning perspective, highly welcome concepts of densifying our cities. You know, the idea you create these radius zones around each train station. You say, we pre-approve high density developments in there. That's cool. But if the developers can't make it work financially, who's going to build it? No one. And so we are further spreading population out. That means we want to shop more locally. This was a roundabout way of answering your question about where is the retail space going to be. Retail needs to be close to where the humans are, because humans want to avoid travel as much as they can. And millennials on the outskirts of town in particular want to avoid the commute, because they will find it, well, they need a lot of convincing.
Yeah, it's certainly a long way to go. And I want to talk about neighbourhood shopping centres and the logic of shopping, but I wasn't clear of that disparity between the cost to build infill sites versus greenfield sites. I didn't realise there was such a gap.
Yeah, no, because I've heard you speak before, Simon, about, one of the solutions is to go denser in those middle ring suburbs, but it's really not financially viable, is it? So, and that gives rise to, the likes of the neighbourhood shopping centres, which we've been going really heavy into because of that, I guess the convenience part of it. Because
the convenience is still key, and I imagine certain people want to buy certain things in neighbourhood shopping centres, but when you look at the the changes in workplace habits and behaviours. I go to my office, we must get, I don't know how many packages every single day arriving through our reception of people online shopping, so which is an absolute boom. And no doubt, Scott, you see it all the time. The explosion of e-commerce is really changing the way in which people approach supply chain optimization and how they can base themselves close to the cities to get packages to people quickly, but without the cost connected in with it. What do you really see in industrial space? And I'm quite keen to know what Simon sees on this as well, because that structurally and functionally is the way we're going to shop moving forward.
Correct, yeah. So you got the e-commerce boom that's, going to keep going for decades to come. But the real, I guess, on the ground experience I'm seeing is since build costs have gone up 50, 60% in the last 5 years, also there's been some yield decompression in the industrial space, which means it's very hard for developers to make money in developing industrial spots. The way they can do it is obviously building smaller warehouses, because you can sell at a higher square meter rate. But there's a real gap in the market, that larger warehouse space, where they're simply not building it because it's not financially viable to do so. That's resulting in, close to record tight vacancy rates. So we're around 2%. Sydney's 2.1, Melbourne's 2%, Brisbane's 2.8%. A lot of that vacancy is kind of in the smaller stuff, but Adelaide and Perth, 1.6 and 1.4%. That's very tight. Like historically, we're sitting at around 4%. So it's very tight out there. So that's going to mean rental growth. good for investors, and it's the pipeline of projects. It's not enough. We're undersupplied as a nation in industrial, and until build costs get cheaper, which they're not, I don't see how they're going to keep up with the demand.
So do you think if you haven't yet capitalised or got into buying some sheds or industrial stuff, you've missed it for the moment?
No, because there's going to be a slow burn in terms of growth for rents. Rents are going to keep going up. You know, like I know we spoke about your property offline, and you've had very good capital growth. The yield's way above what the market should be now because the rents have gone up. But would you sell it? No chance, because there's so much left in the tank. As I said, until build costs soften, there's really no opportunity for supply to hit the market in volume. That'll have a material impact on prices.
And Simon, outside of the viability of commercial investments, where the yields are right for the moment in time, do you see the concept of online shopping changing the way in which Australians procure goods other than maybe food into the future? Or is this structurally the way it's going to be now moving forward?
Even in food. So what we've seen over the long term, so it's only for the last 10, 15 years, the ABS is collecting this data, share of all retail sales that take place online, and they split in food and non-food items. So everything from your supermarket purchase to your cars, to your petrol, to your online electronics, they're all in this. And this chart did rise slowly. And then during the pandemic, it really kicked up. And then it didn't fall back down after the lockdowns all that much. So we further elevated this. So we turbocharged our online behavior, because you know this, once you find the ease of online shopping, you hardly go back. We now do part of our shopping in my household and our supermarket shopping online. We still buy fruit and vegetables in the shop, just to make sure we don't trust the people who pick it. But all the other stuff, a box of cereal, a carton of milk, doesn't matter. Might as well have it shipped to the house. So even that is now, we took retail that occurred in a retail property into a warehouse property, so to speak. In supermarkets, it's usually still in the supermarket and somebody drives it back and forth. But if you think about the shopping that would have taken place at a JB Hi-Fi, it now takes place at Amazon. We don't park the product in a retail property. We park it in a commercial, in an industrial property, and that continues to go up. It will not go up until forever, but it's still on the rise. So industrial, more and more power to industrial. We grow our cities. There's big growth for residential property. Commercial is a bit suppressed probably at the moment, but this means that sooner or later the industrial, the warehouses in particular that are out there, they must become super valuable. Because you cannot just buy or build big warehouses at the outskirts of town and then cart or truck everything into the center of town. That doesn't add up. You need to have hubs more closer to the concentrations of people. And there might be in the future a case where at some particular niches of a city, the best use of a parcel of land is actually industrial, which is quite bizarre to think about at the moment. Usually we think of industrial as cheap land on the outskirts, but at some point, don't sell your industrial property, I would argue here, because it's such a rare asset in an inner city or middle suburb environment.
So talk me through, Simon, then the relationship between online shopping and the industrial assets that support it versus the case for the neighbourhood shopping centre moving forward. Because if most goods can be procured through online connectivity and payments getting simpler, the speed to your door is getting faster. Scott was saying there's a good case for neighbourhood shopping centres, but what's going to be that intersection moving forward between the two?
Well, okay, so many ways of answering this and many demographic angles. So the first one is that I would expect that the costs of shopping online, the costs of getting stuff shipped to you will go through the roof, at least in the medium term. Because we have an absolutely insane skills shortage in Australia. This is one of the fundamental demographic truths about the next 10 years or so, we take the big cohort of baby boomers out of the workforce on one end. On the other end, we take in a smaller cohort. That's an imbalance. All the while in the middle, we have the big fat millennial generation sitting. They are making babies for the next 12 years. And that means they go on parental leave. They leave the world of work at least temporarily. So that's the skills shortage turbocharged. That's quite significant. And on top of the skills shortage, we have the skills shortage's evil twin, the retirement cliff. So that measures what share of a workforce is nearing retirement age. So in 10 years' time, they fall off the retirement cliff. We will not have any truck drivers left in about 10 years' time. Truckies are overwhelmingly over 55. And this is shocking if you remember that just 15 years ago or so, we would have bullied any truck driver 55 and older out of the workforce because they were such an expensive asset, since their bad back claims go up at 55, so we wanted a younger trucking workforce. Now we run out of truckers. In 10 years' time, there will not be a single self-driving truck in Australia outside of a mining site. That's not my assessment, that's what industry experts tell me. So that means, well, what does it mean for trucking costs? I mean, this will go up. So it is actually cheaper to, well, either run this on small autonomous vehicles that might be out there in 10 years' time, or to actually go back to an retail environment where we take the limited amount of goods, throw them into one big store, and you say, well, you come to us when you need it. That's the workforce argument in favor of shopping centers. And of course, you have the overlying consumer narrative in there, that some items are just nicer or easier to buy in person. What does this blouse or pair of pants look on me? It's easier to see in a mirror rather than to imagine this online. And the idea of, you bulk purchase stuff online, you buy 2 items, send the stuff back for free, the iconic model, so to speak. I can't see how this continues for much longer, since the shipping costs and so forth should actually be increasing year after year.
Yeah, there's a lot of selfishness in e-commerce, and you think about sustainability inside and even wellness inside commercial property. To your point around the iconic model, I know of people who they'll buy 10 or 20 outfits and send 19 of them back and keep one of them because they want to try their clothes on at home. Like, if you think about the wastage connected in with that, something needs to change and change quickly. And I think the price point is going to be the catalyst for that taking place, and that'll get more people back into neighbourhood shopping centres, which is probably good for investors.
Yeah, and you got to remember, you got things like pharmacies and just hot food delivery and all that kind of stuff. The old chicken shop there, they're overwhelmingly needed in person. It's the convenience model. So the diversified income is attractive, and like that'll change over the decades as well as tech changes and new trends arise. These shops may die out and be replaced with new ones, but I'd just like the land in amongst suburban areas. To Simon's point, they're making a lot of houses, but that commercial zone right in the middle, it's becoming quite scarce. So that's why I personally invested in them, because I take a 50-year viewpoint on my investment. So in 50 years, that land's going to be worth more in a different form, probably. But in the meantime, there's a diversified income that'll feed it and take care of the income.
And to the view around in places like Australia in particular, with a lens towards our sort of green credentials, do you see habits, or do you see building standards changing to support more sustainable and wellness orientated buildings when it comes in around commercial property moving forward? Do you think it matters right now? The people play lip service to us, but are they actually making buying decisions on that basis?
No, I'm absolutely guaranteed that in terms of regulation, there's one way this is going to be tightened. In terms of, you make sure that your buildings are more sustainable in the long run. I think that's pretty much a given at this point. And that's probably not, when I talk to developers, that's not a problem per se for anyone. The thing that is a problem is that these regulations aren't the same in every state and territory, is that they are an absolute nightmare to just get right. This is too complex. This is not simple enough to understand. People are happy to build. Developers are very agnostic people. Yeah? They build whatever they can sell, and they charge 15-20% on top. That's all they are interested in. So the higher building standards, particularly if they make sense in running costs in the long run, they can of course ultimately be cheaper if you take a longer perspective and so forth. That's helpful. And I would think about, just politically speaking, have an opinion about what will the political landscape look like in the next couple of decades, and what would this mean for building standards, for example. And what I mean by this is, I don't care, Labour or Liberal, doesn't matter. I'm just interested in the third parties collectively when I look at politics. So everyone from Pauline Hanson to the Greens to Clive Palmer in one fun party merged up together. They are increasingly becoming the most important political power in this country. Late 80s, 2% of people voted for primary votes, voted for third parties. Last election, 31% voted for third parties. This will go up in the couple of months' time at the next federal election, and even more after this. So the calling Australia a two-party system at this point is a bit ridiculous. This is at least a three-party system, and we will increasingly run minority governments, meaning that the party in power, they'll have about the backing of 16 to 17% of the people living in Australia, by the way, in terms of votes. So it's not a very impressive number that the PM has as a backing. So they will very much have the need to, well, be dictated, if you will, by the minority parties for a couple of policies. And we've seen the Greens being the biggest third party. We've seen them recently, how they play hardballs in terms of housing affordability issue. They are the party of the renters in Australia. Nobody, politically speaking, has an interest in driving house prices down because of the voters. We ignore all people who don't vote, under 18s, non-residents and non-citizens. Only 26% of voters live in a house that they rent. So why would you make policy for renters? Why would you make housing more affordable? There's no political imperative to drive house prices down. The best you can hope for is for a nonsensical policy that looks like it makes housing cheaper, but actually does the opposite. And this is why first homebuyer grants were invented. You know, there's not a single economist who would think that this makes housing more affordable. Because you give people money, 10,000, 20,000, 30,000 bucks, and you say, yeah, spend it on your house, but don't tell the market about it, so it factors it in. It's a stupid policy from a housing affordability perspective. Because it burns public money. The only thing dumber is the superannuation for property, because it wastes your own money. Don't do this. Don't subsidize these things. That's just a quick political rant. But it's to the point that says we're not interested in driving house prices down. Only third parties have an interest in this. And now these third parties that have an interest in driving house prices down, in pushing renters' rights, in pushing building standards up, these are becoming increasingly powerful despite very much being a minority party.
So sorry, did you say 26% of voters rent who sit within a cohort over 18 years old?
Exactly.
Okay, interesting.
So not households, but 26% of humans in Australia that vote live in a property that is rented.
Yeah. How about the sort of sustainability investment decision making with your clients? Does it matter?
Oh, look, there's some green loans starting to surface, so that has advantages. Where we're seeing it mostly is almost just in the economics of trying to drive outgoings down. So if you can put things like solar or battery storage or EV charging, there's a big market for that. That's growing, especially as the efficiency of panelling and that goes up.
So as a positive commercial outcome, people will do it.
Yeah, and it's from an economic point of view. Yeah. So, and that's what drives investors in both sides. So as power prices go up, it's becoming a bigger issue, especially with the types of properties we're buying, which often can be large multi-tenant type assets. They've got huge common area expenses. Or there's tenants that use huge amounts of power in daylight hours. So if you've got a solution to bring those outgoings down, that has a direct impact on the yield. It creates some equity, or it creates them a long-term higher yield. And that's what we're seeing is a real big thing on the coal face. And then, like Simon said, I've also factored in the political risk in my investing. And that's why I don't think you should invest like it's 2015 anymore. You don't go buy 20 houses. You don't go... expect that there's not going to be a political risk growing because tenant rights are going to be pushed in. And what will that mean? That'll mean less rental growth. Potentially, you'll be trapped with no income if there's disputes and stuff like that. But you don't want to be held in a highly leveraged position with too many of the same properties, especially if these third political parties come up and increase their power, because it only takes one state to close the door on you, and then you're in you're in a lot of financial strife. So that's where you need to really shift. And another small reason why I like commercial, because you're not going to have that political risk. This is nothing to do with tenant rights. There's no tenant rights for industrial properties. So it just feels like it's a little bit out of the spotlight, which I like.
Yeah. When they paused rents for people who couldn't afford it through COVID, resi property, they didn't do it for commercial. You had to actually negotiate with your landlord in order to get some rebates or adjustments to your rent.
That's right.
It wasn't mandated.
Yeah, I'm going down the memory bank, but from memory, you had to show your last BAS statement or two to show you had 30% revenue drop or not. And a lot of the tenants didn't drop in revenue as well. Or they, it wasn't as bad as they said. And as soon as you asked for, show me your income, they didn't want to show you, because what if they're making a huge amount of money and not paying too much rent? It's leverage you're going to have on them forever. So they didn't hand those tickets over.
There you go. So there is quite a lot of political risk around it. I take Simon's point in relation to the fact that it's more than just two parties here, and we do have fringes that have a big voice, particularly when it comes around rents for resi, which in some capacity is probably overrepresented considering the size of the rental cohort. But that's for another time. Now, Simon, you spoke about it very briefly, this transition of wealth. We have baby boomers coming out of the job market. There's going to be a lot of younger Australians who are going to get a wealth transfer at some point in time. And no doubt these are probably a lot of the young Australians complaining around house affordability and housing prices right now. When all that dough lands in their pockets, they're probably not going to want their properties to go down in value. They're going to want to go up in value. But what are you seeing are going to be the major shifts to investment patterns as a result of the wealth transfer that's about to embark upon us?
Yeah, so let's first think through what the wealth transfer actually looks like. If you talk to a financial advisor, they would tell you stuff like, yes, hand over money from the old generation to the young generation while everybody's still alive. You can do this in tax advantageous ways. You get to see the benefits that your wealth has for the younger family. But ultimately, we don't do this, because this involves awkward conversations with your parents about their mortality. You need to come to terms with your own mortality. We don't do it. In Australia, we tend to hand over wealth from one generation to the next when the last parent dies, and that's mom, because she's 4 years younger than dad. She has 4 years longer life expectancy on top of this. But it makes it very easy to measure and to time the intergenerational wealth transfer. So all I need to look for in my data sets is the number of baby boomer women year after year. This number gets smaller. We could call them instances of baby boomer women deaths, but that's morbid. So we just call it wealth transfer. And we'll see about 77 to 80,000 cases of intergenerational wealth transfer this year. That's the status quo. And this will speed up year after year until it reaches a crescendo in 2041 at around 125, 130,000 such cases. So wealth transfer speeds up until 2041. It then stays elevated for another decade, and then it drops because the next cohort who dies are Gen Xs, and they are a small generation. So we have about the 30s and the 40s essentially as elevated wealth transfer. The large majority of wealth that is being transferred sits there in the shape of a family-sized home. These family-sized boomer homes are overwhelmingly located in the middle suburbs of our big 5 cities. So throughout the 20s, 30s, and 40s, we carry mom out of the family home in a box because they're not downsizing. Boomers. The whole downsizing narrative is much exaggerated in Australia. Yes, people move to Noosa, that's happening, but overwhelmingly people tell you stuff like, I want to be carried out of my family home. So once baby boomers die, we mourn for a week, and then their 2.5 kids, they will sell the family home. They'll either sell it to a rich family, because these are expensive dwellings, to a rich family who already take the population density of this particular block of land from 1 person up to maybe 4 or 5. That's cool, so that creates some sort of density in this area, but more often than not, these baby boomer family homes will be bulldozed, and they will make room for 2 or 3 townhouses. And then that takes the population density of this block up to 10, 11 people for this little block of land. Of course, this means more retail in those middle suburbs. It means more traffic in those middle suburbs, and so forth. And then the kids of the boomers, what will they do with their money? Well, they'll inherit the money in their late 50s to early 60s. what do you do at this point of time? Your kids are already out of the house, so yes, you pay off the mortgage if you have one, but most importantly, what do Australians always do when they come into wealth? They throw it at the property market in some way or form, either pay off the mortgage, buy a investment property of sorts. There will be a bit of the money floating straight into consumption, but mostly it will be property. So we'll see this, we'll see a negative pressure on property prices, meaning all those boomer properties entering the market, and we'll see the opposite trend as well, where everybody has this money and throws it at the property market again. So I'm not quite sure how this will play out, but it will at the very least lead to quite a bit of population movement. Because right now, as I mentioned before, we take all the millennials from the inner suburbs, take them to the urban fringe. Who will be available, who will be rich enough to buy the newly built townhouses on the boomers' plots of lands? It will not be the young 30-year-olds of tomorrow who need houses. It will probably be millennials that want to come back closer to town in the more fancy suburbs that they grew up when they were younger. So there's a lot of movement in the property market in the 2030s and 40s. You know, if you're a mortgage broker, if you're a real estate agent, this is a great couple of decades for you, because we will lower the average years that you stay in a property, so there's more property transactions, marvelous opportunities. If you were a government that wanted to actually right-size the property market, means you want to ensure that people live in a property that is neither too big nor too small, you would get away with stamp duty before the 2030s, so that this whole right-sizing narrative can actually play out quite nicely. But that politically is probably a bit too hard, so I'm not sure if we will see it.
It'd be very hard. So one of the misnomers, just listening to you, Simon, is that this idea that as boomers pass away, there's going to be a whole bunch of money going into the hands of millennials and younger people. But you're saying that they're going to be getting this dough in their late 50s, early 60s. They're pretty much done their dash. They're looking down the barrel of retirement themselves. So number one, I would say it's a bit sad that people sitting around waiting until their late 50s or 60s to get the money to actually get into the home they want to move into. And I would say to you, Scott, this idea of younger investors sort of buying property or commercial property even as a result of their parents passing away, it's probably not happening.
No, but even if you think of your own family and friends' experiences, a lot of it, you know, like with our parents, they're still around. There's a 30-year gap, call it 35, and you're always going to get it later in life. So, yeah, the ones that need the money the most are not going to get it. That's the problem here. So, and yeah, interesting. Simon brought up it's probably just going to get put onto a mortgage, pay that off. So that'll keep that part of the economy strong. Banking will be strong, but it points towards higher debt levels for longer periods for younger people.
Yeah, well, those younger people do age, right? We're talking about them sort of turning into their 50s. It'll be you at some point, Scott, when you're looking down the barrel of that. Now, Scott, industrial property's always been seen maybe the third rung on the ladder of the glitz and glamour of commercial investing, but from what I understand, it's becoming a very attractive asset for commercial investors.
Yeah, it's really done a U-turn in the last decade, particularly. Like, obviously, with the e-commerce boom, just pumping that market full of new money. There's been some interesting surveys, one out of Knight Frank, to say that it's the number one asset class family offices around the globe are chasing now in terms of commercial property. So that's where the big money's flowing. They want their portfolio sitting at about 20% of it in terms of where their money and wealth is. So huge percentage, and it's because of the rental growth, the tight vacancy rates. We view it as like the new blue chip asset class, because blue chip is normally associated with security and long-term wealth, and that's certainly industrial property at the moment.
Obviously, AI and automation, everyone's having longer, detailed discussions around it. What's your sort of mid to long-term views on how this is going to shape the way in which people invest in or how we use commercial property?
I would argue that AI is the saving grace for commercial property in Australia. What I mean by this is, at the moment we have quite a few drivers pushing people away from resi. So we essentially turbocharge the working from home movement. That pushes people away from the office. Then we have super low unemployment, so the workers have a bit more leverage. They're a bit more inclined to say, no, I don't want to work at the office. And then, of course, we had this idea that we move millennials further away from the office. So we had quite a few pushes away from the office. What will happen in the long run? we'll grow Melbourne and Sydney at 180,000 people per year. At least a small share of those people will go to the office on any given day in time. So it just takes time to fill offices back up. Melbourne and Sydney grow at around 80 to 100,000 people per year. So that means at least a small share of those people will go to the office on any given day of the week. Also, we change the share of the workforce that works in an office type job. We still continue to shrink the kind of industrial jobs, so we create more knowledge jobs. That also pushes more people into the office. But more than anything, it is AI that pushes people back to the office. It's counterintuitive, but think about what AI does. AI makes a couple of tasks that you do super fast. So creating a map, creating reports, analyzing data sets. These things become much faster than they were in the past. Does that mean that you get to leave the office at 2 p.m.? No. To misquote Jurassic Park, work finds a way to fill your day. And while technology takes those technical, repetitive tasks from you or speeds them up for you, you will be left with more interpersonal tasks. So AI humanizes the world of work. We as human workers are left with much more interpersonal tasks. These interpersonal tasks are by definition best done face-to-face in the office with one another. So we push the workforce, the workday, whatever the pie chart of your day looks like, a bigger share of your pie chart will be interpersonal in nature. So that pushes people back into the office. So ultimately, I'm not worried about the CBD at all in the long term. I, of course, can say this because I don't own billions of dollars of office towers, so I don't care about the timing. I know that in the long run, the CBDs will be more vibrant, more active zones than they were before the pandemic, easily. Getting the exact timing right is very difficult because we need to understand exact numbers of population growth. Most importantly, though, we need to understand the exact speed of technology, and that is much harder to forecast than simple population numbers.
It's not a bad argument. I think Simon's crystallised that pretty well in that AI is just going to mean the needs of human to connect more is going to be greater. That said, though, how long do you need to wait in order for that to happen? Are your client base already future-proofing against AI-driven change? And by that, I would say, if there's going to be a flight back to the office markets, what sort of office markets would you be investing in, and how long are you willing to wait for it to pick up?
Yeah, it's a good question. Not yet. They haven't factored it in. AI hasn't really had a fundamental impact on the commercial market. Even just using my own experience with the business, we've got AI experts working in there to sort of automize things. And Simon's right. You're going to see there's a lot more interpersonal stuff, less doing the repeatable tasks. Just automate it. But Australia is an incredibly inefficient workforce and country, so anything to increase efficiency it will boost profit margins. And as a business owner, that means you can look at hiring more staff or spend more money on marketing, whatever it is. Increasing the profit margin is very important. So if you can get rid of some of those mundane tasks to automate it, that's a big win-win. So I think it's going to be really good for most small businesses in the country, which is the driver of the Australian economy, and that's going to be good for people paying rent. So they might have bigger offices. I could not see a task where we're replacing a person with AI in our service model business. We'll just be increasing efficiency, but the people are still, fundamental for our success, and that's going to stay there.
So what you're saying is we're not going to get replaced at any point soon? Get a couple of robots to do
this?
Very difficult, but yeah, I'm sure it's coding on and rapping on about stupid ideas that I come up with. But hey, Simon, we do this every time we get together. We have burning questions, and I've got some questions here from our listeners and our audience, and I'll frame a couple of them just so a little bit more relevant to demographics. But Scott, the first one here for you: how should investors rethink office space investments in the next 5 years, considering what we've heard from Simon today?
Well, look, it's a long-term approach. I still think you need to look at things from a vacancy point of view and an incentive point of view. If incentives are very high and vacancies are higher, your future for growth is very limited. Now, they're still at very high levels, not far off twice what they were pre-pandemic. So the slow improvement or slow recovery of the office market, I believe, has started, but it's starting from a pretty weak position. Secondary office mostly is where the disaster looms. First grade premium office, it's priced well, tenants want it. So there's segments within markets essentially. So how should investors think about office space? Look, you just need to have security over income. That's the big one. If you don't have that, then pick a different asset class for now, because the supply in the market will, no doubt just keep the rental growth lower than other asset classes for a long time. And if you're an investor focused on a good internal rate of return, having low growth rates on rents is a pretty quick way of not getting the returns you need.
So Simon, your views on AI I found quite intriguing. AI won't kill the office; it'll just change how and where we work. Now, considering that, some of the other aspects of commercial property we've discussed, what would you say are the key demographic indicators to watch for in commercial property shifts? What would be those handful of things that you can keep abreast of to notice when change is happening?
I would become nervous about commercial property once our population growth slows down, for example. I would argue that this is not occurring because ultimately the vast majority of businesses that we run in this country still rely on people. So you cannot, sometimes people say, well, we are running this crazy migration country, we should follow the Japanese model. They managed to shrink their population base, and all the while they actually grew the economy at a low rate, but they still grew the economy. Pretty cool. But we run a different business model. The Japanese run high-tech manufacturing and insurance. That's all they do. And so you can take a Japanese factory, throw it somewhere else in Southeast Asia, have foreign labor produce it in a foreign country, you re-import the profits. Australia, mining, agriculture, tourism, international education. These are things that take place in Australia, so you need people in Australia. We cannot run the country as we run it right now without people on the grounds. Also, our whole taxation model heavily relies on income tax. 54%, I think it is, of our national tax income is income tax. So the treasurer would never ever allow the PM to cut migration numbers. So I would argue that we can take it as an absolute given that we continue the high migration approach in this country. And as long as that is the case, I wouldn't worry at all about the long-term feasibility of any property asset class, so to speak.
And there's a question here connected in with that, and I'll conclude this one, Simon. You could call it a great irony in that you're saying that we're an immigration-fueled economy. That's what drives and shapes a lot of the habits and behaviours of where and how we work. The irony being that the more migrants we bring into Australia, the tighter rentals are, and the housing crisis is exacerbated even further. We need skilled migrants to come in to help build properties in order for us to keep price points to a point where it makes sense for developers to build properties. However, there's so much reluctance to bring in more Australians or new Australians in through our migration policies because of the political pushback. So it's just a circular discussion that goes around and around and around and around. I don't know how we're going to come out of. I don't know who's going to be bold enough to make a change that's going to provide for a sustainable future.
Well, politically speaking, I mentioned it before, I think there is no interest from any of the major parties to cut house prices, to make sure that housing gets cheap. We talk about things like housing affordability, which is a very vague concept, but it is actually linked to two simple numbers. It's you take the median income, you put it in relation to the median house price. That's the income house price ratio. Pretty simple. It should be just under 5 at the very top. We are paying about 14 times the median annual income for a house in Sydney at the moment. So we are so far beyond what is even remotely affordable. But we kind of keep the system running. Do we have any interest in cutting this? No, because only 26% of voters actually want this to occur. So what should we be doing here? Very, very difficult question. If you wanted housing to go cheaper, forget about migration. You could make housing cheaper. Kill off stamp duty. Tax wealth rather than transactions of properties. Don't tax income. Tax wealth in some way or form. That's what all the young policy writers write about. That's not me. That's young policy, geniuses or whatever, thinking through these things. I think there's no political appetite for this in Australia at the moment. So I think Australia in the next 10 years at the very least will be more and more status quo. It will be tightening of housing affordability. Things will get a bit worse. The only way that we allow ourselves to talk about how making housing more affordable is to build more stuff. Because we never ever think about a policy that could make the value of your house go down. You know, John Howard said he never met a voter who complained about their house going up in value. So when Bill Shorten kind of suggested it to a degree, he lost the unlosable election and the two major parties took note. So it's only the fringe parties that talk about making housing cheaper, and you get around it by saying, hey, let's make housing more affordable and just focus on supply solutions. So what we will be seeing is more and more policy that allow for more supply, faster supply, shortening delays in the housing system, faster approval systems. I think that will occur. But do I think a fundamental shift in household or property is happening? Not at all. I think especially under Peter Dutton government, we would see much more of the status quo. Very, very reluctant to structural reform. So I think your standard playbook can continue for another decade at the very least.
There we go, and it probably gives some confidence for commercial property investors moving forward. If they know what the status quo is, they're going to be ambitious, I think, in de-risking portfolios or the strategies around it and shaping. But you don't want to create too much wealth, right? Because someone might come and tax it. It's a big issue. I've made some notes here, and Simon, thanks for your insights today. Just to summarise the chat, and I think you said it, if you're still investing like it's 2015, you're already left behind. I think you're absolutely right with that. And there you could talk about some of those green credentials that we spoke about. The office isn't dead, it's just evolving, absolutely. And insights around AI and how it's going to shape that moving forward, I thought were very good. E-commerce has certainly changed the game. Now, this is intersection between industrial real estate being king, but also there's still a lot of heart and soul and long-term efficacy inside of our neighbourhood shopping centres. Wealth is shifting fast, but I think not as fast as what everyone's thinking. It's not going to change things over. It's going to be decades until that real true wealth effects actually takes place. And our cities, what you call it in Sydney, it's like a sausage type thing. We're sort of stuck in between a European model and a sort of infill model, and we can't really get it right, Simon.
Very much so. So Sydney, of course, will see house prices grow at a faster rate than we would see this in Melbourne, because Sydney now edges up towards the Blue Mountains. So it actually reaches its physical limits, and then you can only go up. Melbourne can sprawl endlessly. There is nothing holding Melbourne back, physically speaking. It can sprawl until it hits, well, Adelaide. So you will see lower density in Melbourne. You will soon be seeing Victorian premiers raving about them having the lowest house price in a capital city across Australia. I think that will very soon be the case, simply because you can build more of the fastest and cheapest housing stock in Melbourne. That'll keep house prices down, but it will make sure that we are an even lower density city. We push people even further away from the CBD, making them even more reluctant to go in the inner city, means more demand for outer suburban retail centers and commercial districts and so forth. For better or worse, Melbourne also becomes more and more car dependent. Urban planners won't like this. It makes for a difficult to manage city. It makes for a very, very big infrastructure backpack that a very broke state needs to carry. So we haven't found a financial model for this to work. But so cities that are more physically constrained, they have to, like Sydney now, they have to go up. And of course, at the moment, this also means more house prices because the development costs are higher.
Yeah, there's lots for us to unpack moving forward. And I would say, if we just keep building greenfield suburbs out in Melbourne, they're all going to be very, very similar. There's no scarcity, etc., etc. Sydney might be the place to be, even though I know a lot of people are operating in and around Victoria at the moment. Simon, thanks for your time. I know you're sort of pretty popular on social media. How can people sort of connect in or follow you or learn more about the demographics group?
The best thing is just to follow me on LinkedIn. That's where I share all the demographic Australian relevant stuff, and then my social media insights on Facebook. Simon Shows You Maps is the Facebook page, or on my Twitter X account, just Simon Kuestenmacher. That's where I share more global data, just maps, a bit of geographical and data trivia as well, because I always find it's helpful to add a bit of factual data to your timeline rather than just the political angry rhetoric.
Well, I do follow you, and I'll track you down some of the other stuff, and no doubt, Simon, we can probably have another discussion at some point, get something to this political argy-bargy. Now, quick favour for us, everyone, if you're tuning into this, myself and Scott, we get to get it in front of the camera here. There's a big team behind the scenes that get a kick out of those reviews, so please keep them coming wherever you're tuning into this, whether it's Apple or Spotify or whatever. Keep the reviews coming, and those 5 stars, we get a kick out of it. Scott, if people want to sort of hear more about what you guys are doing, what's the best way to track you down?
Yeah, just Google Rethink Group or Rethink Investing. So we've got the full suite of help from finance to insurance to commercial and resi buyers agency, and yeah, that's the best way. And thank you so much, Simon. It's I've followed your stuff for years, so yeah, great to have you on the show as well.
It's been an absolute pleasure today.
That's really good. Final question: are you going to do anything different now you've listened to Simon? Nothing.
The same old. Yeah, we. I think everything he said kind of resonated with our long-term approach. Yeah, look, there's it just sort of consolidated what we already know, and that's why I follow people like Simon, because it's like the futurist type investor. You've got to think beyond what we know now. Like, I don't care about politics. I don't care about these little 1%ers here or there. It's about the 100%ers, which take decades to unravel, and that's what I focus on. And
investing for the long term, that's what you're well known and regarded for. This is Inside Commercial Property. I'm Phil Tarrant. It's my host, Scott O'Neill. We'll see you again next time. Until then, bye-bye.